Right now, central banks around the world are selling gold, dumping it, quietly, urgently, at whatever price the market will give them. And the story you are being told about why the story on Bloomberg, on CNBC, in every mainstream financial outlet is not wrong exactly, but it is missing the most important part. And if you do not understand what that missing part is, you are going to make the wrong decision about your money at exactly the wrong moment. So stay with me for the next few minutes, because what I am about to show you changes the entire picture. Here is the surface story. Gold hit an all-time high in late March 2026, $3,500 per ounce. Then it pulled back. It is now trading around $3,220. The financial press has its explanation ready. Dollar strength, elevated real yields, the Federal Reserve holding firm on rates, clean, simple, internally coherent, and completely insufficient, because that explanation tells you what is pushing the price down. It does not tell you who is selling, why they are selling, or, and this is the part that changes everything, what those sellers do when the crisis forcing their hand begins to pass. There are two stories running in the gold market right now. The financial media is covering the first one competently. Nobody is covering the second one, and the second story is the one that tells you what happens over the next 18 months. Let me show you what I mean, and I want to start not with a number, not with a chart, but with a phone call, the kind of phone call that happens inside central bank headquarters in Mexico City, in Astana, in Manila, when the currency is falling and the energy bill is coming due and the dollar reserves are running thin in that moment. A reserve manager does not sit down and review the long-term strategic case for gold. There is no time for that. The question is brutally simple. What can we sell right now today that converts cleanly into dollars without requiring the approval or cooperation of a foreign government? And the answer, almost always, is gold, because gold is the one reserve asset on Earth that you can sell on your own terms, on your own timeline, into a liquid global market without anyone's permission. That is what is happening right now. That phone call is being made, and the price of gold is reflecting it. Here is the specific data. Mexico's Banco de Mexico sold approximately 4.2 tons of gold in February 2026. The peso had just experienced its worst two-week stretch against the dollar since the pandemic, down 6.8% as anxiety over ASEAN renegotiation triggered capital flight. Mexico needed dollars. It's old. Gold to get them. Kazakhstan's national bank sold approximately 6.8 tons in January and February combined. Kazakhstan earns roughly 60% of its export revenue from oil and gas. When Brent crude dropped towards $72 to $76 a barrel in early 2026, the revenue shortfall hit the tenge, immediately down 4.3% against the dollar in 6 weeks. Same answer: sell gold, get dollars, buy time. The Philippines, Jordan, the Czech Republic, different countries, different triggers, same mechanism. An acute dollar need, a currency under pressure. Gold is the last freely deployable asset that does not require a foreign institution's cooperation to liquidate. Now step back and look at the aggregate picture, because this is where it gets serious. The IMF's quarterly data on official sector gold holdings shows that the net official sector position shifted from net buying of approximately 290 tons in the first half of 2025 to net selling of approximately 47 tons between October 2025 and February 2026. That is a swing of 337 tons in a rolling 12-month window, and that number 337 tons is the largest such swing since 2013. And the moment I say 2013, anyone who has been in this market long enough should feel something shift in their understanding of what is actually happening here, because 2013 is not just a historical data point. It is a case study in the single most expensive analytical mistake a precious metals investor can make. Stop for a second, because this is the part that most people watching this video have never heard explained properly, and it is the part that is going to determine whether you make money or lose money on gold over the next 18 months. In 2013, gold fell 28% across the calendar year. The IMF data showed net official sector selling of approximately 130 tons, and the financial media assembled a narrative that was so coherent, so well-sourced, so apparently logical that the majority of retail investors believed it completely. Central banks are abandoning gold. The diversification into non-dollar reserves has run its course. The structural demand story that carried gold from $700 in 2008 to $1,900 in 2011 is finished. Every major institution with a public-facing research operation said some version of this. Goldman Sachs said it. JP Morgan said it. The analysis was everywhere, and then something happened that none of those analyses predicted. In 2014, official sector net buying rebounded to approximately 477 tons. In 2015, it was 590 tons. In 2016, 393 tons. The central banks that had been held up as proof that gold's structural story was finished were back in the market as the most aggressive buyers in modern history within 12 months, because they had never actually left. They had been displaced temporarily by a crisis. The crisis passed. They came back. Here is the question you need to answer with honesty. Are the central banks selling gold today doing so because they changed their strategic view of gold's role in the global monetary system? Or are they selling because they are in a crisis and they need dollars and gold is what they have? Mexico is not selling because its reserve managers decided that a non-correlated, non-counterparty reserve asset is less valuable in 2026 than it was in 2022 when the United States froze Russia's reserves and every central bank in the developing world absorbed a lesson that cannot be unlearned. Mexico is selling because the peso is under pressure right now and it needs dollars right now. The strategic calculus has not changed. The emergency has created a temporary need. When the emergency passes, the strategic calculus reasserts itself. This is the entire story, and it is the story that the institutional price targets Goldman Sachs at $4. 500, JP Morgan at $4,200 with a $5,000 upside scenario, Citigroup at $3,900 are built on, not because those analysts are ignoring the selling, because they understand the difference between a crisis and a policy change. Now I want to be direct with you about something. This channel Recession Warnings exists to give you the same quality of structural analysis that private bank clients in Singapore and Zurich and London pay $50,000 a year to access, not a simplified version of it, not a dumbed-down summary, the actual framework. And the framework is telling you something very specific right now that the price of gold is not reflecting. If that kind of analysis is what you are here for, subscribe right now, because the next video in this sequence goes directly into the BIS quarterly data and what it shows about the relationship between Federal Reserve balance sheet, trajectory, and official sector gold demand. That analysis is the missing piece of this entire picture. Subscribe and you will be there when it publishes. Do it now before you forget. Let me show you exactly how this mechanism works and why it always runs out of road. Think about what a forced liquidation actually is, not the technical definition, the practical reality. When a central bank sells gold under duress, when it is selling not because its strategic thinking changed, but because its currency is hitting record lows and its energy imports are priced in dollars and its dollar reserves are insufficient, it is doing the institutional equivalent of a margin call. It is not price sensitive the way a strategic seller is. A reserve manager who has concluded that gold is strategically less attractive will sell carefully, will wait for favorable price conditions, will manage the transaction to minimize market impact. A reserve manager who needs dollars today to prevent the currency from collapsing further does not have any of those luxuries. The selling happens at whatever price the market offers, because the alternative, allowing the currency to fall further, allowing inflation to accelerate, allowing the political consequences of economic collapse to unfold, is worse than selling gold at an unfavorable price. This is forced liquidation, and it has one property that strategic selling does not: it ends. Mexico holds approximately 120 tons of gold after the recent sales. Kazakhstan holds approximately 274 tons. The Philippines approximately 154 tons. Jordan approximately 25 tons. These are finite numbers. The selling pace of the last 4 months, if sustained, would begin triggering IMF reserve adequacy reviews. Within 2 to 3 quarters, reserve managers know this constraint exists. They are not selling without awareness of where the line is. They are selling to the minimum extent required to stabilize their currencies and service their immediate obligations. And the moment those obligations moderate, the moment the dollar pressure eases, the moment the energy price shock begins to fade, the selling stops, not because of a strategic decision, because of arithmetic. 3 specific conditions signal the end of this phase. Watch the DXY. It has been trading in the 103 to 106 range through the first quarter of 2026. When it breaks below 103 on a sustained basis, the currency pressure driving the emergency gold sales across emerging markets begins to lift. That single indicator is more predictive of gold's near-term trajectory than any commentary specifically about gold. Watch Brent crude, settling into the $70 to $80 range, meaningfully reduces the marginal dollar demand from oil importing, gold-holding economies like Kazakhstan, Jordan, and the Philippines, and watch the Federal Reserve's language, not its actions, its language. A single credible signal toward policy adjustment, not a cut. A signal has historically been sufficient to reverse momentum in official sector gold accumulation cycles within 2 quarters. These 3 conditions are the starting gun for what comes next, and what comes next is the part of this analysis that most investors are not positioned to capture because they are still staring at the falling price and drawing the most intuitive conclusion available to them, which is the wrong one. The structural demand architecture that produced the move from $700 in 2008 to $3,500 in March 2026 is completely intact. The United States national debt crossed $36 trillion in January 2026. Annual interest payments are running at approximately $950 billion, approaching parity. With the defense budget for the first time in American history, when Jerome Powell stood before the Senate Banking Committee in February and described the current fiscal trajectory as unsustainable without material policy adjustment, he was not making a political statement. He was reading the arithmetic of compounding interest on $36 trillion at 4.5%. Every central bank reserve manager in the world who processed that statement filed it alongside the 2022 Russia sanctions episode the moment $300 billion in Russian reserves were frozen with a keystroke in the ledger of reasons why they have been systematically moving reserves out of dollar-denominated assets and into physical gold since 2022. That reasoning was not created by the current crisis. It will not be destroyed by the current crisis. It will still be there when the peso stabilizes and the tenge recovers and the emergency dollar demand subsides. In October 2008, gold fell to $680 an ounce. Lehman Brothers had just collapsed. Every asset on earth was being liquidated simultaneously because institutions needed cash and nothing else. Banks sold gold, hedge funds sold gold, sovereign wealth vehicles sold gold, and the financial press with total justification. Based on what the price action was showing, assembled a narrative of structural collapse. The gold bull market that had carried prices from $250 in 2001 to $1,000 in early 2008 was over. The data supported that conclusion. The price supported that conclusion. The institutional selling supported that conclusion. By September 2011, gold was at $1,923, a 183% move from the 2008 low. Every investor who sold during the forced liquidation phase, who looked at the falling price and concluded that the market was making a judgment about gold's long-term value, missed every dollar of that move. Every investor who understood that what they were watching was a temporary dislocation driven by emergency cash demand, not a strategic reversal, and held their position, captured all of it. One decision, one conceptual distinction, completely different outcomes. Here is the pattern laid out across every major cycle. 1976. Gold falls 47%. The narrative is structural reversal. By 1980, it is up 750% from the low. 2008, falls 34%. Structural reversal narrative, up 183% from the low by 2011, 2013. Net official sector selling of 130 tons, price falls 28%. Structural reversal narrative, 2014 net buying rebounds to 477 tons. 2015 it is 590 tons. The pattern is not a coincidence. It is not a cherry-picked sequence of favorable data points. It is the consistent structural behavior of a market in which forced selling driven by emergency need rather than strategic conviction creates the appearance of a fundamental shift that does not actually exist. The selling is real, the price decline is real, the reversal narrative feels completely logical when you are inside it, and it is wrong every single time. Now here is the question that determines whether this current cycle follows the same pattern or breaks it. Is the structural demand that drove the $700 to $3,500 move still intact? Or did something fundamental change? Let me walk you through the demand side with precision because the numbers here are not ambiguous. The People's Bank of China increased its gold holdings by approximately 316 tons between January 2023 and September 2025 before pausing its accumulation program. Poland's central bank added approximately 130 tons across the same period, the most aggressive European accumulation in the modern era. India's Reserve Bank added approximately 72 tons in 2024 alone. Singapore's Monetary Authority added approximately 75 tons across 2023 and 2024. These are not small portfolio adjustments. These are structural repositions by sovereign institutions managing reserve portfolios measured in hundreds of billions of dollars, and every single one of those decisions was made for the same reason. The 2022 moment when the United States and its allies froze approximately $300 billion in Russian foreign currency reserves with a policy announcement, a keystroke, no court order, no international body, just a decision, and every reserve manager in every non-Western country absorbed that lesson immediately and permanently. If your reserves can be frozen by a geopolitical adversary with administrative convenience, they are not truly yours. Gold cannot be frozen. It has no issuer. No foreign government can lock it with a memo. No sanctions regime can sever a holder from its purchasing power. These properties did not become less relevant when Mexico needed to sell gold in February 2026. If anything, living through a crisis in which you desperately needed an asset you could deploy without anyone's permission makes you more committed to holding that asset after the crisis passes, not less. The People's Bank of China paused at 2,280 tons. Its stated strategic objective, reflected in BOC official commentary and 5-year reserve framework documentation, is to bring gold's share of total foreign exchange reserves from approximately 5.5% today to 8 to 10%, getting to 8% at current prices requires acquiring approximately 1,400 additional tons. That is roughly half of annual global gold mine production. When the BOC resumes buying, and nothing in any official communication has signaled a permanent strategic reorientation, only a pause, it enters a market where supply cannot meaningfully respond to that level of demand for years. That collision between structural demand recovery and supply inelasticity is the mechanism behind every institutional price target above $4,000. Let us talk about the supply side, because this is where the story gets even more consequential. Global gold mine production has been essentially flat since 2018 at approximately 3,300 to 3,400 tons per year, not because the gold is not in the ground, because the capital was not invested in finding it, and developing it. The mining industry spent 2012 to 2018 writing down assets acquired at peak prices and cutting exploration budgets. Mine development timelines run 7 to 12 years from discovery to first production. The projects that would need to be producing in 2027 and 2028 to fill supply. Gaps were not funded in 2021 and 2022. They do not exist yet. The supply response to the price move from $1,200 to $3,500 is not visible in output numbers because on a 7 to 12 year development timeline, it cannot be visible. When the structural buyers return, when the BOC resumes, when the forced sellers become buyers again, when the private sector demand that has been waiting on the sidelines during this correction re-enters, they meet a supply curve that is effectively vertical. Every unit of recovered demand translates directly into price because there is no supply elasticity to absorb it. Think about what that means for the math. Goldman Sachs at $4,500, JP Morgan at $4,200 base case with a $5,000 upside scenario. Even Citigroup's conservative $3,900 target implies a 21% move from current levels. These are not promotional figures, these are the conclusions of the most analytically rigorous precious metals research operations on Wall Street, produced for clients who pay tens of thousands of dollars annually to access them and maintained despite not in ignorance of the current official sector selling data, because the analysts producing those targets are making the same distinction this analysis has been making throughout. Forced selling is not a policy change. A margin call is not a strategic reversal, and when the margin call ends, the strategy that was there before it, the strategy that made these institutions buyers in the first place, is still there, unchanged, waiting to reassert itself. Now let me bring in the silver picture because it adds a dimension to this story that the gold analysis alone cannot capture. The Silver Institute's 2025 annual survey documented the fifth consecutive year of physical silver market deficit, supply of approximately 1,000 million ounces against demand of approximately 1,195 million ounces, a deficit of 195 million ounces, 5 consecutive years, and the demand drivers creating that deficit are not cyclical. They are structural. Solar panel manufacturing consumed approximately 232 million ounces of silver in 2025, according to Wood Mackenzie's industrial metals team. Electric vehicle production required approximately 90 million ounces. Data center and AI infrastructure build-out server connections, power management systems, thermal interface materials consumed approximately 55 million ounces. These are not demand sources that existed at meaningful scale in 2013 when the last structural reversal narrative was being written. They are present tense realities with no viable substitution path in the near term. Silver's thermal and electrical conductivity properties are not replicated by cheaper alternatives at the performance specifications that solar panels, EV drivetrains, and high-density server infrastructure require. The demand is inelastic, the supply is in deficit, and the gold-silver ratio, currently running at approximately 87:1, has reverted to its long-run mean of approximately 65:1 in every previous recovery from elevated ratio levels, a reversion to 65:1 with gold at JP Morgan's $4,200 base. Case implies a silver price of approximately $64 per ounce against current prices around $37. That is a 73% move embedded in the ratio arithmetic before any independent silver-specific catalyst from the industrial sector. That number deserves to sit in your mind for a moment. 73% from ratio reversion alone. Here is something that should make every investor watching this pay close attention. Gold mining equities have dramatically underperformed physical gold throughout this entire bull market. From 2020 through March 2026, physical gold is up approximately 85%. The VanEck Gold Miners ETF GDX is up approximately 45% across the same period, a 40-point gap. Historically, that gap does not persist. During the 2008 to 2011 cycle, the Philadelphia Gold and Silver Index outperformed spot gold by approximately 40% on a cumulative basis. The current underperformance is partially explained by mining cost. Inflation, energy, labor, reagents all rose materially through 2022 and 2023, compressing margins even as gold prices increased. But here is what that cost inflation and the resulting underperformance has created. At $3,220 gold, the major senior producers Newmont, Barrick, Agnico Eagle, Goldfields are generating all-in sustaining cost margins of approximately $1,000 to $1,200 per ounce. At $4,000 gold, those margins expand to $1,800 to $2,000 per ounce. Equity valuations move on earnings. Earnings are a function of the margin above ISK, not the absolute metal price. A 24% move in gold from $3,220 to $4,000 does not produce a 24% move in mining earnings. It produces something substantially larger. The Bank of America Precious Metals Research Team is flagging this valuation anomaly explicitly in their Q1 2026 institutional note. The operating leverage is there. The underperformance gap has created an entry point that the forward earnings math at any price target above $3,500 makes very difficult to ignore. The three-phase arc of what comes next is the most important framework in this entire analysis because it tells you not just where gold is going, but where you currently stand in the cycle and what the specific signposts of transition look like in real data. The phase we are in right now is forced liquidation. The sellers in this market are not making long-term strategic decisions. They are meeting immediate obligations. The selling is real and it is substantial, and it has a ceiling built into it by the arithmetic of finite reserves. Phase 2 is stabilization. It begins when the DXY breaks below 103 on a sustained basis, when energy prices settle into a range that removes the acute current account pressure from oil importing emerging economies, and when the Federal Reserve communication shifts even marginally toward acknowledgement of downside risk. In every previous cycle, stabilization has lasted to 2-4 quarters. It is not a V-shaped recovery. It is a base building period. It is the phase during which investors who understand the mechanism accumulate, and investors who are watching the price chart and waiting for confirmation miss the best entry points. Phase 3 is structural reacceleration, when the BOC resumes, when the forced sellers become buyers again, when the fiscal arithmetic of $36 trillion in U.S. debt becomes the dominant narrative in reserve management discussions instead of the current quarter's currency emergencies. Here's what I need from you right now in the comment section below. Not a vague sentiment, a specific answer to a specific question. Which of the 4 indicators arrives first? DXY below 103, Brent crude below $80, IMF monthly data showing net selling moderating, or GLD NDO ETF flows turning positive? And what is your current posture in precious metals right now? Are you holding through the correction? Accumulating at these prices? Or sitting on the sidelines waiting for a specific signal before you move? Give me a precise answer. The most analytically sharp comment in this section gets a response that goes deeper than anything in this video. That is how this community operates. Subscribe, because the next video goes into the vault flow data from the BIS quarterly review and what it reveals about the timing of phase 2 that no other channel is explaining. And before we close, everything in this video is for educational and informational purposes only. It is not financial advice. It is not investment advice. It is not a recommendation to buy, sell, or hold any asset or financial instrument. Every individual's financial situation, risk tolerance, and time horizon is different. Any decision involving your own capital must be made in consultation with a qualified financial professional who understands your specific circumstances and long-term goals. Do your own research, consult a licensed professional, make the decisions that are right for your situation, not for anyone else's.